What's good, everybody? Mo Sunday service. Today we are going to be talking about whether I should buy Nvidia or whether you should buy Nvidia. I'm Omar Reed. I have over six figures in the market and I own 175 shares of Nvidia. So their earnings release last week was extremely important to me because I'm selfish, right? So, number one, um, if I'm determining whether I should buy Nvidia or buy more Nvidia in my case, whenever I'm evaluating a stock, I'm looking at these five different points. What is the revenue growth looking like? Number two, what are the margins? So for every $100 Nvidia makes, how much does it actually keep? Does it keep $60, $70, $80, $20, whatever that is, right? What's the asset to liability ratio? Number four, what are the risks going forward, and what are they saying about the future guidance of the stock or the company, right? And then number five, if all of those four check out for a particular stock like Nvidia, what price should I actually buy it at, right? That's more of a technical analysis question, while the first four are what we would call like fundamental analysis, right? This is my process. So, number one, Nvidia just released earnings last Wednesday. Where do I find an earnings report? The best way for me is to Google it and Google Nvidia or the ticker and investor relations. When you do that, the results that will come up will point you to their investor relations page where you can find all of their financial statements and commentary about earnings, right? And this is for any stock that's out there that's publicly traded. If you Google their ticker and investor relations, right, you will go to their financial page that's meant for investors and potential investors to get all of their financial information that is public. So, when I did that for Nvidia, this is what I got as it relates to the first potential point that I mentioned, which is the revenue growth. When I'm investing in a company, specifically in my retirement account, and when I'm talking about investing, that's what I mean is I'm usually putting this away in my retirement account or in an account for my kids, something that I'm going to want to earn long term. If I am trading something, whether that's day trading or swing trading, I don't really care about the earnings. I mostly care about the price action. But when I'm planning to hold something for multiple years or retire or help me retire, I'm going to be looking at the fundamentals and the financials and the earnings to figure out if it's a company in good standing that looks like something I want to hold for a long period of time. So, if we're looking at quarter one of 2026, once again, sometimes you just got to disregard how they're keeping up with their financials. We are in quarter two of 2025, but somehow Nvidia is already in quarter one of 2026 as it relates to its fiscal year. So I just look at the most recent earnings report, and I know this was from last quarter. From how they're reporting earnings, right? So they have some financial accounting tricks and whatnot, so they might already be in 2026. But if you're looking at the revenue growth, if you look at the total from last quarter, they made 39.3 billion. This is in millions, folks, right? So Nvidia made 39.33 billion last quarter, and then in this quarter where it's reporting, it made 44.06 billion, right? That is some really decent revenue growth. And if you look at the quarter from the year prior of 2025 in their fiscal year, right, it went from 26 billion that quarter up to 44.06 billion dollars. So what does that mean? It means Nvidia is growing revenue. They grew revenue year over year at 69%, and their revenue increased by 12% from last quarter to this quarter, right? So if we break that down specifically, I took this particular screenshot because I think this was the best illustration of how Nvidia makes its money, which is another thing when you're talking about revenue growth or what a company is doing, you need to really look at like what it's selling. You need to know how Nvidia is making its money. So they have a data center category. The compute is their chips, right? So if you see compute, and then the networking is all of the things that they sell that helps connect their chips together, right? Even the data center space or the physical products and bands and things that they're selling to interconnect their chips. Like they have some other ancillary products that help you tie multiple NVIDIA chips together, right? To make a data warehouse or data center warehouse or a supercomputer, right? So if you're looking at where the growth is coming from, that's where it's coming from. It's the sales of their highly advanced GPU chips, which are the most advanced in the world. They increased sales about $1.5 billion from last quarter to this quarter. And if you're looking at a year ago, they increased sales another $15 billion, which was a 76% year over year growth in terms of sales of their chips. And then their networking. This is kind of what surprised me a little bit from for this quarter, and where I think it's really bullish. All of the data center stuff outside of their chips, that's growing like crazy. It went from 3 billion last quarter to 4.9 billion this quarter, and you see like it went down a little bit from Q1 to Q4 of 2025, right? But seeing this big boost over the last quarter, a 64% growth, right? It seems to me like people have a lot of these chips, but now they're trying to figure out a lot of, or they're spending a lot of money like connecting them together or paying for space for those who are connecting these chips together or building data center warehouses like Nvidia. Also, I thought the gaming sector was going down, right? Uh, because I didn't think Nvidia was really paying attention too much of its gaming chips, its GPUs for gaming. And last quarter was 2.5 billion, and this quarter they even increased that by 1.2 billion, which was kind of a shocker to me because I didn't think this segment was dead, but I thought it was going to be flat. And then professional visualization, automotive, OEM, and others, those are pretty much flat from the last quarter, right? You're not seeing a ton of growth or a ton of revenue coming from those sectors, but they are other places where Nvidia is making its money. But as you can see, the vast majority of Nvidia's revenue is coming from the sale of its chips, right? 34.1 billion of the 44 billion came from the sale of its advanced chips. So that's number one. Is Nvidia growing revenue? Yes. And a short answer to that question, absolutely. This is a company that is growing revenue. It appears people are still buying more chips to build out their LLMs or AI companies, etc. And Nvidia has the top of the line GPUs and chips to do that right now. AMD is the closest competitor, but as I've talked about previously, NVIDIA also has software called CUDA that has thousands of developers, which is another one of their moats, right? Even if AMD develops a chip and the capabilities that NVIDIA has with their chips, they're still going to have to build out the network of developers, and there are just a ton of developers that know how to develop on top of NVIDIA's platform, and so it just keeps them in the lead. Right. So number two, margins, something that I'm always looking at, specifically for software companies, chip companies. You want to see high margins because um, if you don't know how the semiconductor industry works today, Nvidia doesn't actually manufacture any of these chips. It just designs them. It sends the design over to a company called Taiwan Semiconductor in Taiwan, which is one of the reasons why Taiwan is so important geopolitically, right? Is because the vast majority of chips that are designed by the top semiconductor companies in the US are sent to Taiwan to be manufactured, and then those chips are sent back and sold by Nvidia, right? So what that means is Nvidia, while it designs chips, it's mostly software based work. They're not putting a lot of actual money into building plants and fabs to actually manufacture these chips. They outsource all of that to TSM. So by doing that, they can keep their margins relatively high because they don't have a lot of the capital expenditures that a TSM would have because it needs to build and buy these machines to make these little small semiconductor chips. But Nvidia is just a designer, right? AMD is just a designer of chips, so they can keep pretty high gross margins. And as you'll see, right, this quarter it was 60.5%. This was the one thing in the report that worried me a little bit when I first saw it. It was like, look, hey, last quarter they were doing margins of 73%, right? Quarter one of 2025, of their fiscal year 2025, they were doing 78.4% in gross margin. So why is this number coming down? Right, that was a question that I had because I didn't see a tremendous increase in a lot of these other areas, and well, I guess you did see some operating expense increase, and I wondered like why was that? Why did the operating income come down if it is making more on the top line? And then I read the report a little bit more, which is why I do some digging, and it turns out that, let's see, where's my highlighter? Here it is. Turns out we have to, and once again, I ain't trying to get political, but you gotta blame your government for that. Oh, I did that. And I'm not trying to be political once again. I'm just stating facts. They were told that in April, they were told by the US government that they would require a license for their H20 chips, which aren't even their most advanced chips right now. Blackwell is, but even some their I would say second most advanced chips, they're not allowed to export that into China. As a result of being told that by the government, they incurred a $4.5 billion charge associated with the excess inventory, right? So, essentially, they lost $4.5 billion because of the government, right? And that was more than what they anticipated. As a result, their gross margin was less. How do I do that? It was less than it was in the prior years, right? Or not the prior year, the prior quarter of 73%, primarily because of the tariff, right? So that's what I heard anyway. How do I take the marker off? There it is. So yeah. So yes, the margins were down a little bit more than I expected, but at least they had a good reason for it. And if we keep going, let's go to the next slide. We're gonna talk about risk after their asset to liability ratio, but that is one of the ongoing risks for them is the government and tariffs and whether or not they're allowed to sell to everyone. If we're looking at the third point, right, their asset to liability ratio, this looks great for me, right? They have $15.2 billion in cash and $38.4 billion in marketable securities, like things that they could sell to generate cash really quickly. The accounts receivable or money that they're owed from customers is 22.1 billion. They got 11.3 billion in inventory, right? And their total current assets is 89.9 billion. Total assets overall, not including a bunch of goodwill, which is what I kind of look at for a lot of these companies that are reporting they have 50 billion in goodwill. Nvidia is only reporting 5.4 billion in goodwill. So that's a pretty decent number, not too crazy, right? And their total assets is 125.2 billion. versus their total liabilities, which is 41.4 billion. That's a 3 to 1 ratio. And so when I want people to look at this, like, it's like, if you're, would you invest in your cousin or your uncle's business or whoever you know, right? And they're telling you that they have more debt than assets? Probably not, right? And this is why I look at this. It's like, how healthy versus someone that says, I have 3 times the assets to my debt. You're going to be like, oh, you're likely a safer investment, because if something happens, you have all of this cash and all of these assets to potentially sell to generate cash to pay your debts. But if your debts outnumber your assets, you're not a healthy company. So when I'm looking at any long-term investment, the asset to liability ratio needs to at least be 1.5 to 1 generally, unless maybe some banks and whatnot, right? But it definitely shouldn't be less than 1 to 1, where the assets at least equal the liabilities. But I would like it to be at least 1.5 to 1. And in this case, it's 3 or almost 3.5 to 1. And that tells me that Nvidia is in a healthy financial position, because if something happens, the total current liabilities is only 26.5 billion, and the total current assets is 89.9 billion, which means it has 3.5 to 1 in terms of enough things to pay off its debt if something were to happen, or if the economy took a turn for the worse. Nvidia could probably weather that storm because it has a really good balance sheet, right? So, and then the last point of the fundamental analysis is, what's the outlook looking like? What are the risks going forward? Here's another issue. They're essentially saying that revenue is not expected to grow that much, right? This particular quarter was 44 billion. They're not anticipating a huge growth, 45 billion plus or minus 2%. Now, of course, they're being conservative, but it reflects a loss in the H20 revenue of $8 billion due to recent export control limitations, right? Or essentially, the government is not allowing them to sell certain chips to certain companies or certain countries. And as a result, it is going to lose $8 billion. And so, with our current president and administration, who knows if that's going to change tomorrow or in 2 weeks, or if the administration allows them to sell more chips than reasonably anticipated to Saudi Arabia and Qatar and UAE or whoever, right? Um, that might change this a little bit. Who knows? And I think that is probably the biggest risk to Nvidia going forward, is the government, and whether or not the government allows them to sell their chips to countries that we don't like. Other than that, I don't see how a lot of these massive companies like Tesla through XAI, uh, Facebook or Meta, uh, Google, Microsoft, Apple. I don't see how these massive companies are going to stop buying the most advanced chips to make sure that they win the AI race in the future, right? I don't think that Tesla or Elon Musk is going to start buying H20 chips when the Blackwells are available, or whatever the next model after the Blackwell is going to be that makes these processing speeds even faster. I don't think Microsoft or OpenAI is going to be buying the cheaper chips. I think even if these chips become more expensive, the best companies who have the most money in the world are going to be buying the most advanced machinery, the most advanced chips, to be 1% ahead, 2% ahead, 5% ahead of their competitors, right? That's just what I think. Like, I don't feel like that's going to slow down, nor do I think that data center revenue is going to slow down in the future either, because I feel like the cloud is still growing, and many of these cloud service providers are and I forgot Amazon, right? It was one of the biggest companies that has cloud services. They need these chips to run their data centers and their clouds faster and more efficiently. So I don't see how they stop spending money on these chips as well, right? So, and then like uh I wonder what the life of Nvidia chip is, right? We all have computers and stuff. We know these things eventually go kaput. So I wonder how long a chip, a new H20 or a Blackwell chip, actually lasts once it's purchased, to where you might have to buy some new chips because I don't know what the life of the product is. That'll be interesting. That's something for me to research actually, right? So that's number four. That's the outlook. Number five, what price would I buy Nvidia again, or where I would like to buy Nvidia? Here's a screenshot from Thinkorswim. My price, just to get to it, is $90 to $100. Once again, you had your opportunity in March where it dipped to $90. It dipped past $100. I had talked about it previously. That was an opportunity to get in again. I didn't buy shares, but I did make some money during that drop. I sold some cash secure puts and made some money in that particular range, but I didn't buy more shares. I should have bought some more shares, but hey, I did make some money during that drop to that particular range. But once again, just looking at the technicals, now we're going to technical analysis, and this is looking at a 5-year month chart, right? If I'm buying something long term, I want to zoom out sometimes where I'm not going to be on a day chart. I'm going to go to a weekly chart or to a monthly chart to find like what are some really good levels that I've been holding over time. And look at that 100 level. You got some support right there in that candle. You got some support right there in that candle. And it's right there by like a 21-month moving average is that $100 mark. If you want it to be more conservative, or if you want it to start averaging in, if it gets back down to $100, then at 90 level, you got some support right here in that candle, some support right there in that candle, some resistance, some old resistance right there, and some old resistance right there. So I really like that $90 to 100 range to buy Nvidia. I never buy at all-time highs, and my rule is to not buy anything that isn't at least close to 40% off, because my goal is to buy a good asset at a good price, right? Not a good asset at the highest price, right? So that's my Nvidia analysis using the earnings report, my deep dive into Nvidia. And so that to answer the question, should I buy Nvidia? Yes. But at what price? My price to get into Nvidia, whether that's through buying some leaps, whether that's selling some cash secure puts, or whether that's just outright buying the stock, would be I would start doing that once it gets between that $90 to $100 range, based upon what my technical analysis is showing me right now, right? So that's my Nvidia deep dive for today. Now we talk about our weekly stock picks for next week, starting June 2nd when the market opens. Once again, my disclaimer, this entire podcast videos for informational purposes only. Investing is risky. Trading is risky. Do so at your own peril. I am not a financial advisor. You should talk to your financial advisors in connection or in conjunction with your trades and with your investments, and do your own research. Ideally, you start learning enough to where you can start making your own plays and doing your own research, so that you won't even need to listen to me, right? So how am I building my watch list for next week? Well, once again, I'm looking more at the volatility events for next week. We do got the Fed chair speaking on Monday. We got a big jobs report coming out as well. So when you're trading, like I might not get in until after the Fed chair is speaking, or I might decide to get out of my current trade that I'm in right now, which is Uber, before the Fed chair speaks, if it stays flat or if it stays too close to even, right? I'm up on that trade slightly, but If I see it's not up even more at the beginning of Monday before he speaks, I might decide to put a shorter leash on it because when he does speak, depending on what he says, that could cause some volatility in the market up or down, right? And generally, when I'm swing trading, I want a little bit of a smoothness, which is why I don't trade through earnings. I ideally want to take something trending that is pulling back and then back to the upside, or conversely, if we're in a bear market, something that is going down that has a pullback to the upside to continue going down, right? So just be wary of the FOMC speakers, and he's not the only one. There's other FOC members and governors that are speaking next week, and sometimes they can say things that move the market, depending on how they're looking at interest rates for the next cycle or through the end of the year, right? Right now, everyone's is calculating, or I should say, what is it? The CME FedWatch tool um, is pretty much indicating that the odds are that there's going to be one more interest rate cut before the end of the year. And so if one of these Fed speakers says maybe there'll be two or maybe there'll be three, then you might see some volatility to the upside. If they say, we don't even know if we're going to do one, we might just keep rates steady through the end of the year, don't be surprised to see stocks go down, which is why some of these Fed speakers can cause some volatility. So just something to be watchful for when you're trading. Know when they're happening, know when you're entering a trade or something hits your trigger, but there's a volatility event coming up. You might want to wait until that event is over before getting in your trade or getting out, right? So, what am I looking at next week? I go to koifin.com, which is a tool that I use to go look at what sectors are trending over the last 30 days because that is typically my swinging window. I'm typically in and out of a trade anywhere from 2 days to 20 to 30 days, right? 3 to 4 weeks max. My trades usually don't last that long, but there are some outliers that do, some outliers that are short, right? I could get stopped out really quickly, or the market turns and I'm just not comfortable being in the trade anymore. So same thing, looking at what we were looking at last week. I'm looking at semis now. Now that Nvidia has reported and it beat expectations, I would be comfortable swinging semis, right, on pullbacks or names that are currently trending. XLK, the tech sector is still looking good. XLI, the industrial sector, is still looking good. I'm in a trade in that sector right now through Uber, which I got into, I think, on Thursday. And XLY, which is mostly Tesla and Amazon, is trending. But once again, I don't like trading Tesla that much, and Amazon doesn't look as strong as Tesla personally. So I'm going to be focusing on these top three sectors: semis, tech, and the industrial sector. I'm not shorting anything, but if I were, I would be shorting healthcare, which is the worst looking sector right now. And that's actually, if we were to flip this for my long term, I usually want the most discounted name. So what I'm looking at for my long term investments, not swing trading, is probably in XLV or the healthcare sector because that's where the best deals are right now. And so, from a long term prognosis, that's where I would be buying long term in my retirement account. But when I'm swing trading, I want to be trading what has the best trend right now because I don't plan on being in that trade for more than a month, right? Usually way less than that, a week or two or whatever, right? On average, right? So, those are the three places that I'm looking. So, let's get out of here. Switch screens, go to Thinkorswim. For next week, just looking at those particular sectors. Go to my flexible grid. What did I say? XLI. Let's go to that sector, right? Still green trend. Uber was the only one that kind of fell out of trend. It had that big pullback on this day, and that was the day that I took it because it pulled back And this is why I said I'm kind of keeping a tighter leash on it because it did kind of fall out of trend. But for me, it was pulling back to a moving average. So there was like multiple confirmations in a sector that's pretty bullish. So like I'm not going against the tide. What I would have loved to take, which was my favorite name last week, was GE. But as you can see, GE did not pull back. That would have been my favorite name, and it's still on my list for this week. I might not take it unless I get out of this Uber because I don't like to be in the same sector with multiple trades. But GE is still my favorite name. If that would have pulled back on Thursday or Friday, I would have taken that one over Uber, but it didn't pull back. So GE is still top of the list. Caterpillar even looks good, but their options can be really expensive, and I trade with options. Honeywell looks really good. Same thing in terms of liquidity of the options. I've had issues finding liquidity there, but that looks really good if you trade shares. ADP looks really good too, right? Only thing that looks terrible really is UPS. Uber's kind of flat, but that was the one thing that had a pullback, which is why I took it. Like I said, I'm still up on that trade because I took it at 83 bucks, like way down here. And then it had a pop up. It's up to like 84 bucks right now. So I'm still up on the trade, but I'm probably keeping a short leash on that if I don't see some good movement on Monday or Tuesday, right? But XLI in terms of the current, and if you've heard my analogy, I'm trying to swim with the current. Look at that sector. Looks like it's trending, and Uber is heavily weighted in that sector. So if that sector keeps going up, especially if it breaks this ceiling right here, then I would expect Uber to kind of follow it, as well as some of these other names, which is why I love the industrial sector right now. If we go look at SMH, because of Nvidia earnings, SMH is up. I would swing Nvidia on a pullback. I would swing TSM. I would swing AVGO. ASML is really expensive. Micron, meh, not so much. LRCX and AMD, not so much. Intel, definitely not. Intel, worst to breed, right? But Nvidia, TSM, or SMH itself, I would say even in that order, I would rather swing Nvidia first, TSM, then SMH, and then even AVGO. I just feel like whenever I try to trade AVGO, there's always something wrong with the options. Let's see. Yeah, their options are really expensive. Only way I would be able to trade this is through like a put spread, but the options are mad expensive. Look at that. $1,000 to trade one, $1,300. And that's the most. This is the most current expiration date, which is where I want to find the most liquidity. But yeah, I would have to trade this with a spread in order to get in with AVGO because my budget is right now I'm trading with is around $1,400 per trade, and so I can't even scale in or out of this trade if each call is $1,300 approximately. So AVGO is expensive, but hey, if you big baller like that and you got that type of account size, then shit, go ahead with your bad self. AVGO looks good. I would say all three of these. Like, yeah, I like Nvidia, TSM, and AVGO. All three of these next week. And let's go look at the tech sector. Once again, if you use Thinkorswim, instead of looking at all of these names individually, go look at the whole sector. Go build you a flexible grid like this, right? And you can look at the entire sector at once so you can kind of see what everything is doing. Yeah, I'm looking at this. I like the tech sector right now. I don't like Apple to the long side, Isaac. This is why. Look at how the whole sector looks and look at Apple. I don't like that. You're fighting against a tide. Once again, this is tariff. This is a tariff risk because the government's singling out Apple right now for bringing. They wants it to bring manufacturing back to the U.S. and no one knows how that's going to happen. But that's why Apple's doing what it's doing. And then CRM, I don't think its earnings report recently was that great. So Those are the two in the sector that don't look that great, but everything else, Nvidia, we already talked about that. Look at Microsoft. Microsoft has been at the top of my list to swing, but that bad boy does not want to pull back. But I love Microsoft. Look at that up curve. Like, that is a trend. That is a positive trend. That's what you want to see. So from a swing standpoint, that's top of my list probably next week is Microsoft. AVGO we talked about AMD. I really went, that's kind of not as bullish. Oracle looks really good. Look at that positive trend. I like Oracle. Cisco looks decent. Uh, Not as great as Oracle though. So if I had my list, we already talked about Nvidia, we Microsoft, we talked about AVGO, Oracle will be on my list to swing next week as well, and potentially XLK itself, but it doesn't look as bullish as some of these individual names. But I also like the Qs too, so I probably would swing the Qs over XLK. XLK is more heavily weighted Nvidia, Microsoft, Apple than the Qs are. So uh, I feel like since Apple is down, I probably would prefer taking the Qs over XLK if I were to swing it. But that's my list for next week. We could go look at XLV if you're somebody that's always bearish and wants to short. Like XLV is your candidate, right, to short. Oh, look at Lily. This is what I want in my long-term portfolio, so I've been keeping track of Lily. I want it to drop just a little bit more, and then I'm gonna tuck some Lily for the long term. That's really what I'm waiting on. UNH is also a really good buy. That is more discounted, but it has some regulatory issues and lawsuits and fraud allegations and things of that nature right now. So I think Lilly is probably best in class from the healthcare sector. So this is really what I want in my long-term portfolio. So it's actually tempting me to buy it right now. But my new rule is don't buy anything that isn't at least 40% off. It's getting close, but it's not quite there. But if we see some sort of tanking in the healthcare industry next month or this month since we're in June, I will definitely be looking to buy Lilly. It's currently on. It has been on my radar. I have an alert on at $668, trying to buy it close to 650, if possible, right? But if you're shorting anything, this is where you want to be shorting. And you see most of these stocks are negative, right? So Merck is a good short. XLV itself might be a good short. I don't know about shorting UNH because it's already so exhausted. I feel like you should have been shorting that a month or two ago, or a few weeks ago. Thermo Fisher looks like a good short too if it gets back up to one of these levels. But the market is more on the bullish side than the bearish side right now, so I'm focusing on pullbacks and going long rather than going short right now, unless we see some change in the market in June. So that's where I'm at. Anything y'all want to look at? Questions, comments, concerns?
Not on this side. We're good over here.
Yeah, not on my end.
Yep. All right. You still own some Nvidia?
Yeah, I still got it.
Yep. So I'm just saying from an earnings perspective, it still looks like it's decent. Best in class. The
Yeah,
one thing we didn't talk
just have
about,
to,
Costco. Costco's been killing. I'm glad as hell I bought that. So
man, I don't even like to talk about it.
what?
I could have got that I almost bought Costco 300, but I was like, that just seems so high.
Bro, you would have been swimming in money.
Oh
Yeah.
my God, I know.
Because after that earnings hit, because of course after Target ended DEI and Costco leaned into it, more black and brown people are shopping at Costco now.
Yeah,
And so, yeah, man, that was one of my better buys recently. And it's a good hedge because if the economy goes bad, Costco is probably going to be flat
still
or make
wins.
money, right?
Yeah, I think it might even go up a
Yeah.
bit because that's where people are going to be shopping.
Yep. It's a safety sector too. So
Yeah,
that's why, and so healthcare is like the last thing that I need to round out my portfolio. So Costco's my safety play, and Lilly would be my safety play, Healthcare and consumer staples tend to go up or stay flat when the market is down. So that would be a way to hedge all of my tech and semiconductor plays.
Hey, real quick, let's look at Amazon. What you think about Amazon?
I love Amazon as a company overall. I'm sure it had some tariff hits. It came up, popped up from. Were you talking about long term or the swing?
When
Sorry, my swinging chart.
long term is always good to have, which is buy 40% off, you know.
It's flat for me to swing.
Oh,
Like recent, like yes, it has bullish momentum, but it's flat and it's trading between this range. So if I were to swing it, I would wait till it got down to about $198 to get between this level and maybe swing it up to either where like 208 as a first target, maybe like 214.50 as a secondary target where it hit that last level. But there are stronger things in the market right now, like Microsoft, that I would prefer to
gotcha.
be in. Microsoft is breaking not all time highs, but it keeps breaking highs. So it's a stronger trend. So these are the things I'm trying to be in stronger trends, or like GE. Look at that trend. That's a strong ass trend. That's where I'm trying to swing. A pullback into like this range, or at least this is what I was looking at on Friday. It might change on Monday, but I'm looking for something this strong to pull back. What else did we say that had a really strong trend? It was Microsoft, it was GE that had two of the strongest trends, and then Oracle had a really strong trend too. Right, it keeps breaking new highs. I'm looking at that's the stuff that I want to be swing trading, versus Amazon is kind of in no man's land right now. It's just kind of bouncing around. Tesla, I would prefer even to swing Tesla over Amazon right now.
Yeah,
Tesla's trend is more consistent right now than Amazon's is to the upside. It's
Got
breaking,
it.
broke high here, broke a new high, and then broke a new high again. So and I don't like Tesla long term personally, but I would rather swing Tesla over Amazon right now on a pullback.
Gotcha.
Yeah. And then what's the other? Home Depot is usually always a sleeper. No, Home Depot isn't looking good either. Those are usually the top three heaviest weighted in XLY. And XLY itself is more flat than Tesla is, but it looks even. I would even prefer to take this over Amazon. It looks a little bit stronger than Amazon itself, but I think it's because of Tesla. So if I were to swing anything in there, it'd probably be Tesla. I just don't like swinging Tesla a lot just due to the volatility. Elon could come out tomorrow, say something, and then you lost $1,000. A lot of headline risk. You know, nobody's talking about Home Depot like they're talking about Tesla, or no one's talking about GE like they're talking about Tesla. They do talk about Microsoft, but Microsoft hasn't really been under the scope, a microscope recently. It's been the Apples and the Googles of the world lately. What's the Google looking like? Even Google looks better than Amazon right now because at least it's breaking new, like not all time highs, but at least it's breaking highs consistently.
Yeah, I was playing with Google too, trying to get in there, waiting for that right
Yeah,
there.
but yeah, even that looks better than swinging Amazon right now. Amazon just looks flat to me, like a trade that's not going to go anywhere.
Gotcha.
Yeah, and yeah, waiting on my Uber because that was a big drop into a 34 day moving average. That's why I bought it. It was like two confirmations because it was exhausted and it hit a zone. And so yeah, I'm up, but I'm waiting for if it breaks that what is it, like $85 mark to go back up, I'll be scaled out. I think my first target is right here at this yellow line. That's target number one. And that's right around like making 25% off my position. Then I'll set my stop at break even if I hit this target on Monday. But I'm not gonna give it because it was falling out of trend a little bit. We had a long trend and then falling out of trend, but I just like the way the sector is going. The sector is hot. So the sector is hot. It's going to be easier for Uber to catch up, you know. So at least that's my thesis. It's like a catch up play to the sector. All right, folks, that's it. Mokama Sunday service. Make it rain without the umbrellas. 8 a.m. every Sunday. We talk about stocks and what we buying, what we not buying. All right.
Thank you.
All right, folks. Peace.
Appreciate you, man.
Appreciate you, man.